Hello, fellow compounders. Are you interested in building a dividend-paying portfolio? In this video, I'll share with you my process for picking dividend-paying stocks. I'll explain the metrics I use, and I will end the video with an analysis of two well-known dividend stocks, legendary rivals Coke and Pepsi. Welcome to the Always Be Compounding Club, where we share ideas on how to build, grow, and enjoy wealth. I'm your host, Dennis Chen. I'm a full-time investor and CFA charter holder. Welcome aboard. So let's get started. A good dividend-paying stock is like a cow that provides milk every day. We want to own healthy businesses that can grow faster than inflation and can pay us dividends for a very long time. So why do we own dividend-paying stocks? We own them for 4 reasons. Number 1, they are less volatile. Number 2, they provide a steady stream of cash. Number 3, dividends can keep up with inflation. And number 4, having to pay dividends keeps management honest and disciplined. Here's what I would like to have in a dividend-paying stock. Number 1, a predictable business that is growing at a rate faster than inflation. Number 2, a business that will be around for a long time. Number 3, a business that's led by honest and capable people. And number 4, that I can buy it at a reasonable price. I'm going to assume that before looking at numbers, that you know what the business that you're analyzing does, and you know what's its competitive advantage and a little bit of its background story. First, to identify predictable businesses, I will look at 4 metrics. Number 1 is revenue growth. What is the historical and projected growth? I'm looking for businesses that have some growth. It doesn't have to be high growth, but enough where it can beat inflation. Number 2, earnings per share. Earnings per share is very important. I want to make sure that the business is earning money. We need a profitable business to be able to pay out dividends. Number 3, earnings growth rate. I want businesses that are growing earnings at least faster than inflation, but prefer that they at least grow as fast as the sector or market that they're in. And number 4, the number of years of consecutive dividend payments. Has the dividend grown rate equal or higher to inflation? Obviously, the longer the streak of consecutive dividend payments, the better. Second, for a company to be around a long time, I'll be looking for indications that it has a sustainable competitive advantage. The metric that I'm going to be using here is ROIC, or return on invested capital. ROIC measures the return of every dollar invested in the business. ROIC is equal to the net operating profit after tax divided by the debt plus equity. I'd want to know how stable the ROIC has been over time. Has it been consistent over the past 5 years or 10 years? A stable ROIC usually indicates that the business has a sustainable competitive advantage. Third, how can we detect good leadership? This is a little bit more challenging and will require several metrics. Good leadership will be reflected through financial stewardship. I'd like to find companies with a great balance sheet, good capital allocation, and financial management. These are the metrics that I'd look at. Number 1, debt to equity ratio. I'm looking for companies with low leverage. I prefer no debt, obviously, but the debt to equity ratio will depend on the industry. However, I would start with a debt to equity ratio of less than 2. Metric number 2, dividend yield. The dividend yield is equal to the annual dividend per share divided by the price per share. The yield I'll accept will depend on the growth rate of the dividend and the payout ratio. I'll go on into more detail in the example of Coke versus Pepsi in the next section, so stick around. Number 3, dividend growth rate. I'm looking for dividends that are growing at a pace that's keeping up with inflation. Number 4, the dividend payout ratio or payout ratio, which is equal to the annual dividend per share divided by the annual earnings per share, or actually annual dividends divided by annual net earnings. The payout ratio lets you know what is the percentage of the earnings that is paid out as dividends. A healthy payout ratio is somewhere between 40 to 60%. If the ratio is too high, it's because the business doesn't have much growth or any projects to invest in. Number 5, shareholder yield. Shareholder yield is equal to dividend plus net buybacks plus net debt repayment divided by the market cap. This is also an indicator of the portion of earnings that is distributed back to shareholders. In fact, I prefer to use this indicator to the dividend payout ratio. But dividend payout ratio is more popular, more common, and it's easier to find without having to do much work. Number 6, return on equity. Return on equity is equal to the net income divided by the average shareholder's equity. This indicates the efficiency of management in operating the business and financing structures. The wise use of leverage will increase the return on equity, but it may also increase the riskiness of the business. Fourth, to measure if we're buying at a reasonable price, we need to do the valuation of our businesses, and obviously you would pay a price that is below or at least the same as the valuation that you got. So the metric that we would use is price divided by fair value estimated. Now let's look at an example. We'll analyze 2 dividend-paying companies. They are classics. These are companies that have had a rivalry going on for ages. They are Coke and Pepsi.
Is this the one I'm looking for? Yes, this is the one. Diet Coke. I must find it. The look of it. I search for the taste of it. Everywhere. The style of it. Diet Coke. It's the one I'm after. It's the feeling, it's the laughter. No one can replace it. I must find it, I must chase it. The taste that satisfies me. It's the one that can surprise me. Just for the taste of it. Sugar-free, 1 calorie. Just for the taste of it, Diet Coke.
We'll run down our selection metrics list and compare both, and we'll select the better one to buy for the dividend portfolio. Full disclosure, I own both Coke and Pepsi in my investment portfolios. By the way, remember that this video is for educational purposes only and it's not financial advice. I am not your financial advisor and you are responsible for your own financial decisions. I'm going to assume that we all know both of these companies. Both companies are in the manufacturing and distribution of beverages worldwide. The main difference is that about 50% of Pepsi's business is in the production of snacks. It owns Frito-Lay, the maker of Doritos. Coke doesn't have that business, it's only beverages. So let's go down the list. Revenue growth. I'm looking at the last 3 years. Coke has 6.7% revenue growth and Pepsi 7.1%. It's very close, but I'll give the win to Pepsi. Earnings per share going forward. Coke is estimated at $2.46 and Pepsi $6.69. Really can't compare them this way. Both have earnings, which is good, but we'll have to look at the price to earnings ratio to really compare this. Price to earnings ratio, PE. Coke is 24 and Pepsi is 25. Advantage goes to Coke. You're paying $24 for $1 of earning versus Pepsi where you're paying $25 for $1 of earning. Earnings per share growth rate, last 3 years. Coke is 14.5%, Pepsi is negative 14.5%. Something's kind of weird there. Pepsi looks negative growth, but it's because in 2018 it had an extra $3.5 billion one-time boost in earnings, making the 2018 number fairly high, and those $3.5 billion was due to the tax benefits in 2018 and some sales of bottling operations. But revenue growth remained consistent and it's close to Coke, but we'll give the win to Coke. Number of years of growing dividend payments. Coke has 58 consecutive years and Pepsi 50 consecutive years. The winner is Coke, but both are impressive. So both Coke and Pepsi passed the first filter. They both have predictable businesses. Now let's compare the second filter, the sustainable competitive advantage part. Return on invested capital. Now let's compare their return on invested capital, current ROIC, and the 5-year average. Coke's return on invested capital is 15.3% and Pepsi's is 18.6%. These are healthy numbers, but the winner obviously is Pepsi. And their 5-year return on invested capital average are also good. Coke has 11.3% and Pepsi 17.5%. Again, the winner is Pepsi. Obviously, these are the number 1 and number 2 players in the beverage market. They both own many billion-dollar brands and a distribution infrastructure that is difficult to replicate. They both have very excellent moats or competitive advantages. Third, let's see how effective has been their management. Debt to equity for Coke is 1.6 and Pepsi's 1.8. Both are okay, less than 2 is good. The debt is manageable. The win goes to Coke. Dividend yield for the last 12 months. Coke is 2.9% and Pepsi is 2.6%. Coke has a little advantage here, so the win goes to Coke. Dividend growth rate, the average for the last 3 years, was 3.2% for Coke and 6.7% for Pepsi. Pepsi has the clear advantage here. The payout ratio for the last 12 months, Coke is 78% and Pepsi 66%. Coke looks fairly high, Pepsi looks better, but then again, remember, we just went through the COVID pandemic. So anyways, we'll give the win to Pepsi here. Shareholder yield for the past 12 months, Coke is almost at 3% and Pepsi is 2.9%. Coke wins by a hair. Return on equity, 5-year average, Coke is 35.5%, Pepsi 61.3%, obviously because it's a little bit higher levered, and so Pepsi is a clear winner here. And the price to fair value estimated using Morningstar's fair value estimated, both Coke and Pepsi are around their fair value estimate. So I would say it's a tie. So when we tally up each metric, Pepsi gets 6 points and Coke gets 6 points. It's a tie. Both companies passed all our metrics. They're good, investable, dividend-paying companies, except for the price. I'd obviously like to pay below our fair value estimate, but it's a reasonable price to pay fair value. So given that I'll break the tie, I would go with Pepsi because its growth is a little bit faster or higher than Coke, and it also has Frito-Lay, which Coke doesn't have. So other than that, both of them are solid investments, but obviously I'll favor Pepsi. Let me show you quickly a real position of Pepsi in one of my retirement portfolios. In September of 2011, I bought 175 shares of Pepsi for $10,685. Let's look at the Pepsi position from a dividend collection point of view. I've collected a total of $6,307 in the past 11 years from my Pepsi position. Take a look at the yield on cost. Yield on cost is the dividend divided by my original investment. In 2012, the yield on cost was 3.49%, or call it 3.5. I received $373 in dividends, and it has been going up every single year up to now. Isn't that great? I started out making 3.5% dividend yield in 2011, and now that same position, that same investment is making me a 7.5% dividend yield. It has grown as the business has grown. That's one of the big benefits of investing in dividend payers. You can at least equal or outpace inflation. Where have you seen a certificate of deposit of a bank do that? One last thing. I must confess that I prefer companies that do buybacks instead of paying dividends. I reviewed the reasons why buybacks are better than dividends in this video. I suggest you watch it. However, I don't mind owning dividend-paying businesses inside tax-sheltered accounts like 401ks or Roth 401ks or Roth IRAs. So there you have it. What to look for in a dividend payer. You're looking for profitable businesses that are predictable, have a history of paying growing dividends that keep up with inflation, and are managed by honest and capable people. If you want to learn more about building portfolios that pay dividends, go ahead and hit subscribe. Also, if you liked the video, I'd appreciate it if you hit that like button. Thanks for watching. Remember to always be compounding. See you in the next video. Take care.